webinar based upon the director's office's liability policies and the umbrella policies and what we're going to see here, but really just want to give a quick background. Over the last few years, almost every community association has been impacted by premium increases on the property and the liability policies. A favorable renewal was met with a 5 to 9% increase. An unfavorable one was met with 20 to 50% increases, and possibly more if there was a labor law claim or any kind of large open claim. And I'm not going to go into those because Rob will at some point when he goes into his portion. Some experts predicting that the property and liability policies will level off in the second half of 2022 or the early part of 2023. But the umbrella policies and directors and officers liability policies are also experiencing issues. So community associations are going to experience rate increases, limit decreases, and possible change in terms and conditions for the renewals. Rob and Adam are going to explain why, how we got there, and what to expect in the immediate future. You may have noticed that Rob and I share the same last name. That is not a coincidence. He's my brother. So I get to interact with him regularly, and I hear all the horror stories. I've known Adam for many, many years, and I can tell you that the two of them are experts. And what they may say or what they have to say may be disturbing, especially for your insurance budget. I would probably heed what they're about to tell you. Now, before we go into that, I want to just go into, as I had mentioned, the property and the liability policies have experienced some difficulties over the last couple of years. And I just really want to give you a quick background on why. This is a slide that I saw. I saw this on a website at one point, and I liked it because it just shows what's contributing to property policies increasing. In 2021, there were 20 different billion-dollar weather and climate disasters. That's just in the United States, okay? And that's just property related. So anytime there's going to be this many disasters and the insurance companies have to pay, they are going to raise premiums. What is also contributing is COVID certainly hurt here. So I'm not going to go onto this whole page because it'll bore you to death, but just some statistics here. The national increase, average increase in reconstruction costs after these losses was up 17% between 2020 and 2021. Residential construction rose 14.5% in 2021. Lumber costs have been way up. At the time that we started writing this webinar, it was up 85% in the past several months. And as you've probably heard, the term supply chain issues that's been disrupted for such a long time. And that's on a global issue, and that's not expected to end anytime soon. So due to construction costs increasing, skilled labor hasn't been available. That's also contributed. So really, the long story short, these catastrophes plus shortages in building materials, lack of available labor, and are not only driving up property claim costs and thus insurance rates, but the need for higher property limits to make sure they are adequately insured in the event of a total disaster. So although we expect the property and the liability to level off, we may start seeing, or we probably will start seeing, increases in building limits upon renewal. And I'm not really going into the liability because everything that is contributed to the liability and the premium increases is what is contributing to the umbrellas and the D&O policies as well. So I'm going to turn that over to Rob and eventually Adam, and they will address that. Rob.
Okay. Hi, everybody. As Ed said, I am Rob Mackoul. I've run an umbrella program, which I'm sure a lot of you have participated in for the past 19 years. And, and there's a lot going on. And I didn't think it was fair to say, hey, here's what's happening. You're going to pay these more rates without telling you why and how we got here. So bear with me for 5 minutes while I explain kind of, the timeline of everything that's happened over the past couple of decades that got us to where we are. So the biggest thing is that insurance companies are reactive. Now, I am not putting all the blame on insurance companies by any means. There's a lot involved with program managers as well, but insurance companies tend to be reactive, which means that they see what's going on and they react to what's in front of them rather than trying to be proactive. Excuse me, and that's not always done the right way. It could be good or bad. They'll see what's going on with another carrier, and then they'll decrease premiums to follow them, or they'll expand classes to follow and keep up. And and that's what happens when you react to certain things. You throw the baby out with the bathwater, so to speak. And rarely on either side is there foresight for what could be, or hindsight with proper analysis with what should be. And that's a lot of what we're running into now. And then what happens then is that a poor niche becomes a self-fulfilling prophecy, which I'll explain a little more as I get into some of the other items that I have here. So I think my notes follow this slide. Yeah, here we go. So the RPG market, which is the master policy umbrella that you're all dealing with, started as a home for very clean vanilla business, primarily community associations. And somewhere around the mid to late 90s, a company started to work with these programs and offer very high limits for very low premiums. Other companies saw what they were doing, followed in, and then, in reality, there's only a limited number of these opportunities that are actually good opportunities. Excuse me. So what happens is, as time goes on, the agencies that had these programs had a huge competitive advantage, and it was almost looked upon as found money. We get these high limits for a class where nothing's going to happen. We never expected there to be any kind of claim of any real magnitude, and RPG in general is a very niche exposure, and the complexities and nuances are not always understood by even some of the people who have been in the insurance industry for years, and that all contributes to where we're going, which I will get to again. So carriers do what they always do. They react. They saw that other companies created what they considered to be easy streams of revenue for themselves. And with these RPG programs, the burden is on the program managers. So the company's not issuing policies. They're not collecting premium. Everything is done by these program managers. So they all jumped in, and there were dozens of umbrella programs almost overnight. Okay, and in reality, as I said, a niche like this really only has so many risks that fit and should be considered. And quite frankly, there are only a certain number of program managers that can operate as a partner and an extension of the company as well. And it just got completely out of control. So it usually happens, the good overwhelmed the bad. The quality of risk suffered because everyone had to find a way to survive. Programs with better rates wrote the higher end business. Everybody else had to expand to get premium in the door. And that expansion naturally morphed into accepting any type of habitational business, because an RPG is like kind. So a condo and an apartment are people living there. It's habitational. Let's all do it. So we've got into higher end apartments, followed by real estate schedules, eventually non-standard classes like student affordable senior housing, all written at a low rate. It took years for there to be a fluctuation in the rate between condos and the lesser quality business. But for a long time, there was a flat rate that everybody got the same thing. Rates continue to go down as every program tried to compete with the bigger programs. So for over a decade, there were a select group of companies that played in this space, and we all, meaning we, the program managers, all knew who to go to approach for capacity. Problem is the boards, which I'm sure there are a lot of people from the boards on here, became conditioned to think that you needed all of this insurance, $100 million in coverage, but more importantly to you being conditioned to think that way, you were also conditioned to think that you would always pay a low rate, and that $2,000 or $1,500 or $3,000 was enough premium for a $100 million limit. And in reality, it's been proven that there really rarely, if ever, is a need for such limits, and that the premium is never going to support that kind of model. It's just not. So what companies should have done, and again, this goes back to the reactive thing, should have increased pricing each year so that at some point the pricing would be commensurate with the exposure. Instead, everybody followed the leaders down the rabbit hole, and eventually the losses did start to come. For years, there were no losses, or very few. The first sign of trouble was New York labor law. I think Ed had touched on that slightly in his intro. In the late 2000s and early 2010s, labor law in New York was a big problem. Now, labor law, if you're not familiar with it, is a law in New York that puts the full responsibility of any loss on the building owner if a worker falls, usually gravity related. If the worker falls from a ladder, falls from any height, that responsibility is fully on the landlord. And for a long time, we had to adjust. For a long time, some of the boards weren't sophisticated enough to have the proper risk transfer controls in place, the proper hold harmless, and got hit with a bunch of claims. So as time went on, we put those controls in place, but it was still a big issue. The other problem with an umbrella is that it is what's called a long tail exposure. You have a property claim, right? You have a lightning strike, a collapse or a fire. You come in, you look at it, you pay the claim, you're out in a couple of months. It is not the case with liability claims. If someone falls down or something happens, there's legal stuff, there's reporting, there's depositions, there's negotiations. It could be years, and it is years. And the standard tail, as they call it, it's called a tail, is 5 to 7 years for umbrella. So all of these claims didn't really start to hit until several years after the programs came into effect and were offering these coverages. And then after labor law, there was a little bit of time where, you know, we were able to brag that the only losses we've ever seen were in New York. There's nothing outside of New York. And then the ones outside of New York began to hit. So somewhere around 4 years ago, we started to see some claims outside of New York and some classes that maybe should not have been in an umbrella program like this to begin with. Resort hotels, public housing, you know, larger suburban complexes where it just wasn't the cream of the cream. And then that self-fulfilling prophecy, as I mentioned earlier, started to take effect. Now, what that is that if the company looks at this type of niche and says, hey, there's a lot of losses, we're going to jump out of it and it's a bad market, then nobody's writing it anymore. It does become its own self-fulfilling prophecy, and now you don't have a good niche anymore. I'll explain a little bit more of that. The biggest problem with these losses in the last few years, which really contributes to where we're going, is what's called social inflation. Okay, social inflation is an increase in the judgments that have been rendered against insurance companies and defendants over the past few years. And when you have a jury of peers, what happens is they see a deep-pocketed company, they see someone who's a victim of something, whether it's justified or not, and then you know, it's always been that someone goes in and asks for $5 million when they're hoping to get $500,000 or get, you know, $1 million, whatever it is. In recent years, people have been asking for $20 million and they've been getting awarded 12. So social inflation is the increase in the judgments that there have been awarded in recent years, and that has affected everybody. Losses that would normally be a couple of $100,000 and contained within your GL policy are now going to the umbrella and hitting the umbrella hard. Okay. The other side of this is that RPGs are often misunderstood. I'm not sure how many of you are familiar with what an RPG is. I won't go into that explanation here, but suffice to say that it is the program you've been dealing with all these years. And these RPG divisions were standalone entities run by a director who had a lot of experience in RPGs. Oftentimes, they eventually got absorbed into a larger excess program where the people they were reporting to didn't necessarily understand this. And the only real experience they had with these types of programs was losses and how the premium is so low compared to the limit. So it's a very specialized niche that most people in the industry are not familiar with. And when the losses started to come, companies bailed out. So instead of assessing the risk and saying, hey, let's raise rates and keep the good stuff, push out the bad stuff, they just said, we're out. So what happens then is 5 years later, losses are still coming in because you have that long tail. They're not collecting premium anymore, and it looks even worse than it is. And there's your self-fulfilling prophecy. If you say it's a bad niche, it's a bad niche because you get out, you're still collecting losses, but not collecting premium. So
I just want to jump in for a second.
Yeah, sure. Absolutely. Yeah.
You had mentioned social inflation, you mentioned the labor laws, basically in two different areas. I mean, I just wanted to expand on that because the social inflation also contributes to the larger labor law claims. And I had lunch probably 2 years ago with the president of one of the insurance companies, and he said they've had more labor law claims that have exhausted, now they're an underlying carrier, that had exhausted their policy limit. They've had more in the past 7 years than they had in the entire history of the company before that, which was 40 some odd years. So when you're saying social inflation, I just want everyone to understand, the labor law claims have been and always will be a problem in New York unless those laws are changed. And now those claims, like you were saying, that used to be able to get out for they'd sue for $5 million in hopes of getting 500,000. Well, they're suing for 10 million now, and they're getting 5 million or 6 million. So, I just want everybody to understand that social inflation and labor law really, they go hand in hand here.
They do. And the other thing is which I did not have in my presentation, but you brought up a point that made me think of it, is that labor law has been taken advantage of by both the insured and the lawyers who get involved. They know that there's full responsibility, and unless they had an ironclad contract in place, they're going to get some money out of it, and the insurance companies end up settling just so it doesn't turn into a much bigger claim. So this is a cyclical ripple effect that has affected everybody in the industry for years now.
And do you foresee it going away anytime soon?
I do not. I think at some point it will level off. But I think there's a very big key here, and that is educating the insured, which I know the better agencies like yourself and some of the others we deal with do educate their insureds and get involved in their risk assessment and their risk management. I think it's very important that a retail agent does not just go in, write the premium and get out the door. They have to educate their client, and they have to make sure that these controls are in place, because there is a way to fight it and make sure that you're not going to be on the hook for this, but it's tricky and it's tight and requires a lot of extra work.
It is true. We teach a separate class titled No Insurance, No Entry, which really just goes into how associations protect themselves, because like you said, even if you cross your T's and dot your I's, there's still there's still the opportunity for people to be awarded large judgments. So not crossing them and not dotting them just leaves you wide open. So
it's true. And lawyers are not dumb. They're there for a reason, and they make a lot of money for a reason, and that is that they will find any loophole they can and try and drive a truck through it. And unless everything is really ironclad, and even sometimes when it is, there's going to be a way that they'll get their client paid. It's the nature of the beast.
Agreed. I also wanted to mention, you were talking about the programs before, and just a real quick history and you can expand on it for sure, is programs. There were programs within a program for a while. So you would have a property management firm who would have their own program for their properties they manage, and then put it in the program, and there were no minimum premiums. So I can remember some insureds would be getting $200 million in coverage for $500. So when you say they're not getting enough premium, it is the truth, and that's one of the reasons we're here. Is listen, everybody took advantage of it, and there was nothing wrong with it at that point, but eventually things catch up. So that I'd say the days of $200 million, $500 are probably long over, and that's one of the reasons we're here.
I think the days of 200 million might be long over too, which we can get to a little bit. But just to expand on that point, is that was part of the issue with chasing carriers down the rabbit hole. For the longest time, it wasn't let's increase premiums and get to where we need to be or should be. It was, wait, these guys are cheaper, let's find a way. So those property manager programs you mentioned, we did them for a long time too. They were just ways to get around the minimum premiums, which we considered to be so high, and now they look like nothing. And that's just the direction we've gone. So getting back to I am just about at where we're headed. I got one more little thing to you, is that the carriers that were big players in the market began to jump ship, as I did touch on that a little bit earlier, and they had a rough experience with these types of programs, and some of the divisions they were absorbed into didn't understand it. So the number of carriers who were willing to listen to a pitch from a program like us and others like us has dwindled to almost none. And that's kind of where we find ourselves now. Companies that have never played in the space, run by people who never played in the space, and look at a 20-year history of increasing claims and poor loss history for a number of reasons. They're the ones making the decisions on these, and it doesn't paint a pretty picture. Poor risk selection, mounting claims, higher judgments, terrible loss ratios. It just doesn't paint a pretty picture. So we're all struggling with this type of thing now. So that kind of leads us to where we're headed. All right, we're going to continue to see a market correction for the foreseeable future. Now, market correction is exactly what it sounds like. It's years and years of low premiums that the market has to catch up. I mean, if you're on this call and you're a consumer and not an insurance person, you've seen this in your homeowner's insurance. You've seen this in your car insurance. If there's a rate increase, even if you've never had a claim, that's a market correction. And at the end of the day, you may not have had a claim, but insurance is a communal thing. All of your premiums and everybody else's premiums come together, and they pay the losses out of that. So if there's losses somewhere else, it's going to affect you, whether that's fair or not. And that's what's going to happen here. You're going to continue to see a market correction. Your limits are going to come down probably, not because we can't offer higher limits, but there are no longer carriers who are willing to provide $25 million each like there were. So we had 4 in place for $25 million each. Now, most carriers don't want to put more than 10. And for us to get back to 100 million, or for any program to get back to 100 million, requires 10 carriers, and they all want premium. So you're going to find that decreased limits are probably the way you're going to go to keep things affordable, and it'll be completely unaffordable to get some of those higher limits. Carriers have exited the marketplace, and with that is that what's going to happen, in my opinion, is that the rates are going to get much closer to what's called the standard market. Standard market for years generally had a kind of a baseline of $1,000 per million as a minimum premium. So think of that. If you want $100 million, you need $100,000 in premium. Obviously, we're not going to go that route, but we're going to get much closer to those types of rates and still be at a discounted rate. You're going to see less programs offering this coverage, and you're going to see a contraction in the classes of business that are going to be allowed into these programs. And we, meaning our program, have already seen that. We're working on a lot of different things, and the appetite's going to be smaller. So you might even see, and I know we had touched on this yesterday, we might even see some what's called non-admitted coverage with some of these programs. Non-admitted coverage there's two ways you can go with that. There's bad risks that can't find a home anywhere else, and then there's an ease of doing business and getting into a certain market without having to hit all the regulations. And so it's not always a bad thing, but we're probably going to see, at least if not a primary layer, we're going to see some excess layers in our tower have non-admitted coverage, which this a whole other subject. We won't get into it here, but that's kind of where we're going with this. Higher premiums, lower limits, some coverage that is going to probably be different, along with a much more streamlined appetite. So if you've got apartment buildings, it's going to be a struggle. Your higher end condos are going to be relatively okay. You know, they'll be the ones that are the preferred class, but that preferred class has changed over the years. Probably will change a little bit more, and then they'll kind of be a new normal. As Ed had said, I don't think we're ever going to be at the days of really high limits for really low premiums again. This stuff is cyclical, so I'm sure it'll bounce back a little bit, but it'll never get there. Never should have been there, but it is what it is, and now we do what we can to correct it. So that's pretty much where we are. I'm happy to take any questions from you, Ed, or if I don't know if we're opening this up to questions.
We're going to do that at the end.
Okay.
I have two things. One, I just want to clarify what non-admitted is. Non-admitted basically means they're not licensed in that state to do business. They can do business. They're just not licensed there. And there's plenty of times, as a matter of fact, there's plenty of insureds right now who are with non-admitted carriers on their property or liability, simply because, like you said, it could be there may be some problems there. There may be some losses. So non-admitted is not a bad thing in all cases. Yes, you generally want to be admitted, but in this case, if you have a non-admitted carrier who's willing to come in on the program and they're going to be providing good coverage and not any exclusions that could be detrimental, then I would think that non-admitted is probably a better way to go than admitted, who is not providing what the insureds need. Would you agree about that, Rob?
I do. Yeah, non-admitted kind of gets a bad rap because a lot of the times risks that have bad losses or are just not vanilla enough, for lack of a better term, get put in there. It's the only place for them to go. So people kind of get an idea in their head that that the not admitted means it's a place for bad business. But that's, as you said, that is not always the case. And you know, most of the time, it actually gives the carrier more flexibility to do things rather than having to adhere to state guidelines. And even though that sounds bad, hey, we're not licensed in the state, it is not nearly as egregious as it sounds. So yeah, you're pretty much right on, right?
Okay, here's the question I do have for you. We're hearing the term nuclear verdicts a lot more lately, which is basically described as social inflation on steroids. So you have these larger verdicts, $10 million or so. That are you seeing more and more of them? Because I'm reading more and more of them. I've seen a few myself. Are you seeing them? And what should insureds do if we're seeing higher verdicts at this point, and they really can't afford a $25 million umbrella? I mean, what are they to do?
Yeah, we haven't seen what I would call a nuclear. We've been more the victim of social inflation, and I can give a quick example we had a claim where a woman was there were signs everywhere said do not go to the roof. She was actually given the key to a roof by a property manager who isn't insured on our policy. So right away, you know, we're responsible for it. She was going up to the roof, climbing the ladder with a couple of glasses of wine and a bottle. I guess she was meeting someone up there, fell, unfortunately became a paraplegic, and they paid the full limit of the policy. I believe that was $5 million, whatever it was. But that is an example of something that should not even necessarily be liable for, that where there was a verdict and it was a large verdict. And we are definitely seeing a lot more of that. the nuclear verdict, I'm not sure if you're referring to size of the claim. It sounds like you are, but what we're
It's
seeing
like
is
10 million or above, basically.
yeah, we're not seeing that, thankfully. But what we are seeing is companies settle for what sounds like a lot so that they don't have to be subject to getting out there and paying even more. And we've seen a lot of that.
Okay.
Had that example had a 10 million limit though, they might have paid 10 mil.
Probably, yeah.
So would you suggest that, and I get this question from time to time, should I go for 10 million instead of 25 million? Because if I only have 10 million, they're probably only going to sue and get 10 million rather than go for 25 million. So
Yeah,
I mean, I don't know if you...
well, I do want to start by saying that this is not advice, so do not take that and run with it. But I
Disclaimer.
would say that you're dead on. Is that what's going to happen is in a lot of cases. Now, if you've got a truly terrible injury, there's nothing you're going to do. They're going to be on the hook. But for people out there just trying to get a payday, that lawyer is going to look at the limits in place and they're going to go for those limits. So, so my suggestion would be to get what you can or want to afford. Get as much as you can, and just make sure you're protected, because the judgments are getting bigger, and especially in a place like New York where it's such a, like the same claims that go for that much in New York will go for a fraction of it in Iowa. So I would say pay for what you can and what you can afford, what you're comfortable with. I wouldn't overdo it, and I would, at the very least, try and wrap my head around the fact that we were playing with monopoly money and fantasy numbers for all those years as far as the limits and the premium we were paying.
All right, last question then, so we have time for Adam. But what's the largest claim you've seen or heard about piercing the umbrella?
Heard about? Oof. I mean, there was one, I mentioned resorts. There was a claim that one of our competitors had. They were on a resort in Disney that paid out like $56 million. I heard about a claim recently that paid out 40-something million dollars. We fortunately have not seen that. We have had some pretty large ones. Not in the current program, but our previous carrier had a fire that where the owner was found completely at risk because they used oil-based paint, which, if you don't know what that means, the fire just lights up and goes crazy. That one paid out a large amount. So those claims are out there. In most cases, they are usually apartments or risks that don't belong in there. We have not seen those types of nuclear judgments in condos for the most part.
Okay, great. Thank you, Rob.
Thank
All
you.
right, Adam, turning it over to you, buddy.
Yeah, that was rather depressing, Rob.
My pleasure.
But it's the state, it's reality, right? And mine might be slightly more uplifting, but you're going to hear some commonalities between, what Rob was talking about the umbrella and on the D&O side. I think that the main commonality is the pricing, and I'll get to that. But these premiums are on the smaller side as far as insurance that's being purchased by associations. And, Rob mentioned social inflation. We're definitely being impacted by that. Get to some numbers as far as what we're seeing on the claim side of things. So, as far as less options for D&O, there's still a lot of product out there in the marketplace. But what's happened over time is, some carriers have pulled out, but they've really found those niches that they want to write in. They might want to only write single family homes. They might only want to write, condos under 150 units, no employees, no amenities. So you can find the coverage out there, but they're fewer and fewer. And specific to the co-op market in New York, I think there's just a small handful of really viable D&O options available there. Carriers are pulling out or just not, their pricing is just off the charts. They'll write it, but they're going to get premium dollar for it. So it puts a strain on the whole marketplace. Before I get into coverage reductions, I'll do a little bit of background. So, going back 15 years or so is when we really started to see the D&O policies being enhanced. One carrier added breach of contract, right? And everybody else has to have breach of contract to keep up with the marketplace. Defense outside the limit, they were available, but carriers are charging upwards of 25% for that. And we're seeing that automatically included on a lot of D&O policies now. And, with these enhancements, we've added cyber. There's components of cyber in D&O policy now, the employment practices component. So there's a lot of different components that have been added over time and weren't really a concern but where we are today, most certainly feeling the impacts from a loss perspective with those additions.
You have, and I'm
yeah.
going to jump in. You have coverage reductions there, so
Yeah.
I don't want to steal your thunder if you're going to get to it, but are we going to see some of those starting to be removed from the D&O policies?
I think cyber will eventually. We're still feeling the, we're seeing more. I'm being asked more questions about cyber than I ever have. On the social engineering, which is more on the crime side, we're definitely seeing some losses there. But I think as cyber evolves and people keep getting hit more and more, it will probably be more of a standalone product. But I heard somebody added excluding third-party discrimination claims now. I've seen in a number of states foreclosure exclusions being added to the D&O policy. There was a big class action that took place in Nevada over laws involving foreclosures and fees. And it was a significant, the biggest losses we paid overall. There was hundreds and hundreds of associations involved, and just think if each one averaged 30 or 40,000, that number just really blows up. So you're seeing, the market correcting on the foreclosure issues. And I think the discrimination just with what's going on in society, that I think carriers are looking at that more and more. The labor laws, I think employment practices, the coverage included in the D&O, you might start seeing some sublimits, maybe some higher retentions, things like that, because honestly, the D&O, the pricing for a D&O is cheaper than a standalone EPO policy would be in a number of cases. So,
and I'm just going to interrupt you two real quick things. I just want to clarify. The EPL is employment practices liability, which are suits lodged by employees. Could be discrimination, wrongful termination, sexual harassment, etc. So when you say, there's coverage under the D&O policies for employees who are suing the board, and you're saying it's actually cheaper. The D&O policy is cheaper. If they had to go out and buy that policy elsewhere, it would be more expensive. So that actually makes no sense.
We don't underwrite, we don't underwrite to it. If you go back 15 years, our application, how many units are there? Do you have any big lakes or docks or anything like that? Do you have claims? And that was essentially it. And if it's boxed underwriting. It's evolved over time. We ask a lot more questions, when there's an economic downturn, people stop paying their assessments or dues, and it creates issues. So they just get addressed over time and corrected. And when we go back to the pricing, again, our average premium is probably closer to $1,500 on a D&O policy now. Obviously the co-ops in Manhattan are going to be paying quite a bit more because the claims reflect that. Hawaii is a nightmare. They have very few options available as far as admitted carriers. And, when we get to the claims numbers, when you think about this and we're charging $1,500 and we're paying out $40,000, $50,000, just defense costs only claims on somewhat frivolous lawsuits, it pinches the carriers and rates have to go up.
I was gonna say, I was always told that companies writing D&O in New York and New Jersey, and the reason I picked those two states is because that's a lot of what my clients are, that the D&O companies lose money in both New York and New Jersey on D&O. Is that true?
That is 100% accurate. Yeah, the Midwest isn't going to have the same D&O exposures and concerns as anybody on the coast. I'll say the Floridas, Californias, New Yorks. So it's they carry it. So before back in the day, we just used to say everybody gets the same rate increase, whether it's Delaware, whether it's Miami-Dade, Florida. But now we have a lot more data available to us, and so we're really picking and choosing where we take rate or where we just don't want to write anymore. There are territories in the US that we can never turn it upside down. It's just that such a bad loss ratio. You just sometimes have to cut your losses, because if you keep the business there, you're never going to dig out of it. You could double the premium there and it wouldn't really impact the overall negative outlook of those claims.
Got it. So our basically East Coast insureds are making out well at the pricing they have right now. Let's put it that way.
It's, we take rate a little bit every year. We try to, more of an inflation rate, try to avoid these big 15, 25% rate increases that I'm seeing happening right now. with some other programs. They try to stay flat, like, because a new carrier will come into the marketplace, low ball, and then everybody has to, and then buy up a book, and everybody has to start competing at that lower pricing. And it hurts the industry as a whole, and it leads to a market correction, which is, we're trending in that direction now. Carriers, they weren't getting their return on investment either. That comes into play. It's not always just losses. So there's just a lot of issues that go into these pricing. And when you're dealing with such small premiums, any little change makes a difference as far as our loss ratio.
Understood. Thank you, Adam.
So then we'll go to the next slide, and these common allegations, a lot of them are consistent throughout the country. Doesn't matter about where they're at. Breach of fiduciary duty is just a very wide encompassing one that we see consistently. Discrimination, harassment, that's always been around, but we're dealing with more of those and more of those than we anticipated, I feel. Foreclosures, again, a little bit more cyclical depending on the economy. But when the economy goes down and people stop paying their dues and foreclosures happen, the countersuits are often and expensive. So people fight tooth and nail to not be evicted from their property. Architectural review decisions, breach of contract, as I mentioned. If association just chooses to not pay that painter the $50,000 they owe them and they get sued, well, now we're defending that, and we could spend $30,000-$40,000 just defending the board's decision to not pay that vendor. And there's just certain things you can underwrite to, and some the claims are going to be the claims with the D&O. Doesn't matter what you underwrite, you're not going to really be able to remove too many of these issues.
Right.
Something new that again wasn't anticipated is these emotional support pet claims as well. The ADA issues are they're just happening more often. I saw one where people sued because they wanted a beehive as an emotional support pet, miniature pony as an emotional support pet, and so and these all just cost money. We have to get in there and defend them and deal with it. So they all really just paint a bad picture. And then the rentals, Airbnbs, you've got outsiders coming into associations, staying there, probably not treating it as well as a unit owner would. And so most certainly feeling the impact of that as well.
I want to ask you a question just to expand on Airbnb. Would you, in New York, it is basically illegal. So would you defend a claim regarding Airbnb, or is that something that will be denied simply because it's not something they should have been doing?
No, we deny things that they shouldn't be. I mean, we cover things that they shouldn't be doing quite often. So yeah, no, if they're violating the bylaws or governing docs, yeah, a state law won't trump the policy. If we're not excluding that in the policy form, I don't think we're going to be able to get out of that one. Understood.
Thank you.
So the cost of the claims, I'm not going to get into specific numbers. Our average payout has jumped significantly over just the last 2 years. Significantly, far outpacing any kind of rate increases we have taken. And that trend, I feel, is going to continue, part of the social inflation. $1 million isn't what it used to be. That used to be a really big number. Now I feel we're kind of numb and watered down to it, and these high dollar amounts just aren't. Nobody appreciates how large they are.
And I'm going to jump in there. I've been doing this 27 years. And as I was telling you the other day, I saw my first D&O claim in New York in a co-op or a condo that exceeded the $1 million in defense costs. So it has pierced the umbrella at this point. It is not over. So for the first 26 years of my career, I could say I've never seen one that has exceeded $1 million. I can no longer say that. So like you said, $1 million isn't the same thing as $1 million anymore.
Right. Yeah. No, it's not. And even on the property side of things, we get pulled, the D&O gets pulled into failure to maintain or repair. And you would think that would be a property policy, but the way the D&O works, if there's 17 allegations, 16 of them are denied because of property, but one triggers the defense, the D&O carrier is defending 17 allegations. So it's not difficult to get those defense costs up to the mid six figures. It happens far too easily. And then the frequency, we're seeing more of them, not nearly as severe not nearly the same increase as we're seeing on the expense side of it, but frequency, people are suing more. I've referred to it as hurt feelings coverage, the D&O. I think COVID had something to do with some of this influx. We did see some issues, a lot of submissions of notice of potential claims early on. But just, the fact that people being at home more, seeing people staring out that window a little more, paying attention to what other people are doing, it creates not a healthy environment, in my opinion, and it leads to a little more personal issues going on within the associations or the members of the association. So, what does this mean? Again, you're going to continue to see rate increases, and they're not.
What kind, if you don't mind me answering, like if you had to tell an association or a property manager what to budget as an increase on the D&O, what would you say?
Yeah, I think the condos, probably should expect close to a 10% increase. It's going to vary. I feel if the higher unit values, are just, they have more claims than a 50 unit condo isn't the same as a 300 unit condo, right? So the higher unit condos, I feel, are going to feel a pinch. The co-ops are going to continue to take rate because, to your point, other parts of the country carry New York to an extent. But your homeowners associations, we do have a lot of frequency on that, but the severity is not what it is like it is on the condos and the co-ops. So I think low single digit on the HOA front is what should be expected. And that might continue, you might see 2 years, 3 years of similar increases.
Understood. Okay, just I don't know if you're done, because I had a couple other questions.
Yeah, no, I'm all done.
In New York, you mentioned co-ops in New York. Do co-ops, in your opinion, have a higher exposure than condos, or no?
Yeah, I just think because they tend, they can be wealthier, right? Wealthier members, owners, and with that, then money isn't an issue. They could fund litigation. They unlimited resources. So that creates an issue. And then sometimes claims are a little more difficult to settle when you're dealing with certain level of individuals. And so all those things, just the stats should prove that they perform quite a bit worse.
Understood. And I would assume that the co-op, since board approval, that would certainly probably contribute to more suits than a condo, which is
they're set up quite a bit differently than the condos, and how they run the organization and the improvement process and all that type of stuff. So that most certainly adds exposure.
Okay. And the second question I have is, we insure a lot of smaller buildings who they don't want to pay for a standalone D&O policy like you offer, so they opt for the endorsement with inside the liability policy for $150 or $250. What advice would you give to that 8-unit building that that only wants to pay $250 for the coverage?
My personal opinion is, just because it satisfies the governing doc requirements doesn't mean that it's the best fit. I mean, I've seen endorsements where they don't even cover non-monetary claims, and that is just somebody, they're not demanding money, they demanding a change. So they are they just I lost my train of thought.
So they're not suing for money, basically. They're just
they're not
suing
suing for money.
change.
They're demanding a change, and these D&O endorsements, they're not covering that, or they don't include discrimination or wrongful entry, wrongful eviction. I mean, the list goes on and on. They breach of contract. A lot of these things that I've talked about that we have issues with from a loss perspective, they're not covering. Yeah.
Understood. Okay. All right, I think that's all I had. Rob, I'm just going to ask you a quick question, then we have several other questions here.
Yeah.
Adam had mentioned, I asked Adam what the boards and property managers can expect from a budget purposes. I know it's a hard question to ask you, but if you had to tell someone what they should budget on their umbrellas, what would you suggest?
Are we assuming that everybody on the call is in our program, or is that not a fair assumption? Because
that is not a fair assumption.
Okay. I can tell you that we will see a minimum, and again, we're just being real here, a minimum of 50% increase on the negotiations we've been having. And and it's likely to be more. I don't know how much more, but I would budget for at least 50% more than what you've been paying in our program. If you're not in our program, everybody else is headed the same way. So I would look to budget a minimum of 50% more than you've been paying up to this point, and that's part of a very big market correction.
Okay, so 50% on the umbrellas, and Adam said, it could be low single digits, but 10% to be safe. So from a budget perspective, they should budget for this, and if it's less than that, then everybody's happy at the end of the day.
Yeah, just to clarify, I don't think it's going to be less on our end. I'm saying at least. So if you want to be fair, I would budget for more, but 50% is the benchmark here.
Understood. Okay. All right, Adam, I'm sorry. Were you done? I'm sorry, I didn't mean to cut you off.
Yeah, no, I'm good.
Okay, bud. All right, so we do have some questions here. There's actually, Rob, there's two regarding the status of your program. I'm going to tell you, take that offline. I don't, I would say just reach out to those individuals separately.
Yeah, I know Max. I don't know Gene. You guys are welcome to email me separately, and or call me, and I'll have a discussion with you. So.
Right, and Rob's contact info is right there. You can send him an email. We do have a few questions here. One is, I am on the board of a 5-unit co-op in New York City, no employees. We previously had D&O through an umbrella. It is no longer included in our umbrella. We received separate D&O quotes around $25,000. Is this the new normal? How can a small New York City co-op find reasonable D&O coverage?
It was the excess coverage though, right? Yeah.
Well, it sounds like from what I can tell, that the umbrella probably provided excess coverage over the D&O previously, or maybe this thing was included in the liability and they can't do it anymore, and they received a separate D&O quote for around $25,000. That is not the new normal. There's got to be a reason. I mean, it could be that the simple fact that there's either a large claim, several smaller claims. As Adam had said, D&O is going up, but if you were paying $1,300 or $1,400 last year and you're getting a 10% increase, it's only $150, $160. A 5-unit co-op in New York City, no claims, D&O policy should be somewhere along the lines of $1,000. If there is some claims, it certainly will go up, but that is not the new normal. So I would say if you want to just email me separately and give me some more details, I can give you a better answer, but it's really hard to answer that question, but I can tell you that is definitely not the normal.
Yeah, or it could be with the carrier that just doesn't specialize in this, right? So, yeah, and you'll see that if they don't know what they're doing, they're just like, hey, let's just put this big number out there.
It's true.
So you want to work with the specialist. I did see something on there asking if they could quote D&O online. Yes, you can.
Yeah, I wanted to address that as well. The way the question is phrased, from what I'm looking at, is that they receive D&O coverage through the umbrella, and obviously you have to have a primary policy first, and then the umbrella comes in afterwards. So if your primary policy is okay and they're quoting you separate umbrella coverage for that much, I have heard of these crazy thoughts from carriers that they need to charge a lot more for D&O. That should certainly not be the case on your primary or regular D&O policy.
Thank you, Rob. All right, another one is it true that D&O does not cover suits by co-op shareholders? Adam?
No, that is not. But I can speak from my program. I can't speak in generalities, but I'm not aware of any such exclusion as far as D&O.
Neither am I. So
we cover insured versus insured, right? They're considered insured, so that won't be.
Right, and I don't either. I mean, the main exposure in a co-op are the shareholders suing the board because of the decisions the board makes. So that is actually, that is typically not true. And we have one, I am a board member of a condo association in New York City. One owner was running an illegal Airbnb a couple of years ago, resulting in ECB violations to both the unit and building. Can ECB violations affect our insurance premiums? Adam, I'll let you answer part of that, then I'll answer from the liability perspective. Does that affect the D&O premiums?
I'm not familiar with ECB. What is that?
I'm assuming it's probably the same as the HPD violations.
Yeah, I don't know.
Okay, let's.
Maybe once you respond, it'll trigger something in me, but yeah, I'm not following.
Okay. Basically, it appears to be the electrical violation.
Environmental Control Board. Environmental Control Board. It's an environmental thing. Any
violations, at least from the property and the liability side, are going to be held against you. So we're in what's called a hard market right now. In a hard market, the insurance companies, it's kind of like a seller's market. So they're in control here. They're handpicking the risks they want. And so anything with any kind of violations where they can pick up on this, it is an issue to them. So I would say it certainly could affect the insurance premiums simply because not that they would raise the insurance premiums, but let's say you are building that 10 carriers normally want to quote, and now only 2 are willing to quote, or 1 is willing to quote, you're probably going to pay a higher insurance premium in the long run.
Yeah, and the D&O policies tend to, I don't know if that would fall under pollutants, but they exclude a lot of stuff related to pollutants as well. So I'm not sure if that would play into that or not.
Certainly could. All right, regarding umbrella policy increases, you mentioned 25 to 30% increases. The SHOA is a master association, amenities only, no claims in 36 years. Our increase was 160% for lesser coverage. $12,000 went to $31,000. What happened here, Rob?
I mean, there could be a couple of things that happen, and it really is a different answer depending on what program you're dealing with. HOA has always been a lower rate. It could be that company jacked the rate and said HOA is no longer going to get a lower rate than a condo, and you get the condo rate. So not only do you get the increase, you get a jump from HOA rate to condo rate. Could be the program you're dealing with. The contraction in limits has been happening a lot. I've seen a lot of this type of stuff. I'm surprised to see that on an HOA, to be honest with you, but I would say to have, I don't know if this is a property manager, it's anonymous. So I don't know if it's a property manager or a client. I would say to shop it with a different program. There's not a lot of them out there, but depending on the size of your HOA, I can't imagine that you should get a jump like that. So I would try a different place.
I'm hearing the same things in the marketplace from my agents. They had a large scale HOA that went from 15 to 60 something thousand, I think, less limit. Yeah. And so it's, again, I'm not aware of who the program was, but that's the trend. I think they're revisiting how they're classifying, I think, the setup of these associations.
Right. I'm going to throw a couple of things here because I do see this from time to time. I think with the HOAs, the insurance companies are starting to realize there's a larger exposure there than they expected. So whereas premiums sometimes were very, very low, now they're realizing, okay, well, we only have the amenities, but there's 360 units. That means there's 360 people who are going into the gym, the pool, etc. So they have adjusted their rates. But I've also seen situations, and Rob, you can correct me if I'm wrong here, some umbrellas are based on the underlying premium. So if the underlying premium on the liability has gone up significantly, that would drive up the umbrella premium in some cases as well, correct?
I can't necessarily speak to what this person's asking about, but if they had what's called a standard market umbrella, then yes, it is based on the premium of the underlying GL policy. But most of these programs are based on a unit count. So it's possible that there was a change in appetite or a rate increase or different carriers. I mean, just as a quick example, we had one carrier at 25 million a couple of years ago. For the first 25 million. They dropped to 15. We had to get a second carrier, so that premium doubled. So there's a lot of different reasons that the premium could have gone up that much, a lot, and we can't touch on all of them here. But I'm hesitant to give any solid answer without knowing more. But there are a lot of reasons, and as Adam said, it's just out there with the market correction. Umbrellas have gone up significantly. Is probably the word I should use. So.
Okay, thank you. A couple of questions. Will this webinar be available for us to share with our agents? The answer is yes. So Kira will be sending out copies later. We had a question. Is there on average in New York City a formula for the umbrella premium in relation to amount of coverage, number of units, type of construction of the building, anything that I left out? And the same person also asked, Adam, you can find after, is the amount of D&O premium tied to many units in a co-op and how many directors and offices?
You want to go first?
That's probably the easier one, Adam.
Yeah, we don't ask, strangely, we don't ask anything in our D&O about the board of directors. And while they're most likely the reason for the claims that we see, we don't ask about them. We don't ask how many there are. We don't do any research on that. So we're strictly, it's a unit count. It's a unit bands, 1 to 10 units, 11 to 25. And so just the bands go up, and obviously the higher the number, the more premium they'll be paying.
Thank you.
Yeah, as far as the umbrella rate, the umbrella rate doesn't have anything to do with the type of construction, because that's a property thing. There are things that apply to the type of construction and the life safety that is required, but basically you have a per door count. So if you've got 20 units, it's 20 times whatever the rate is, and there's a minimum premium. So if your minimum premium is 1,000 and that 20 unit rate does not get you to 1,000, you jump to 1,000. There is not an average. There's not, that's the formula basically, but the amount of that rate and the minimum premiums vary from carrier to carrier. So there's not a really straight answer on that one. I can tell you that New York City is the most expensive and will continue to be. So do with that what you will.
Thank you. Hi, Rob. There's another question regarding the program. Just if you want to add that to the list to reach out to. I think there are some other questions.
Well, there's
here
one
in the
question
chat.
about whether we're continuing. The answer is yes. We're in negotiations with several different carriers. We anticipate having something to announce fairly soon. I'm not going to get into those things. You can email me separately if you want. We can talk more. But the short answer is yes. We will absolutely be continuing the program.
Great, thank you. And Adam, I think you answered the only other question I see there. Can they quote D&O Online with Ian Graham? And the answer you said is yes, right?
Right.
Okay, I think that is all I see in terms of questions. Rob, Adam, thank you so much. I think it was very helpful, definitely for me. So hopefully everybody else feels that way as well. Our contact info is on the screen here if you have any questions. Thank you, everyone.